Hey everyone, in this video, I'm going to bring you one spectacular dividend stock that's down 47% off the high that I think you can buy for 2024 and beyond. So I'll highlight what this dividend stock is. Of course, I'll discuss the dividend yield, the prospects over the next few years, compare that with the valuation to describe and support my reasoning for why I think it's an excellent dividend stock to buy. So let's jump right in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the dividend stock I'm going to recommend to buy for 2024 in this video is Target. Target is down 47.17% off its high in in the last few years. Now, Target is also in my list of top 24 stocks to buy in 2024. If you want to see that video, I'll link it at the end of this one. So I'm bullish on Target stock. So let's discuss the reasons why I think Target stock is a buy right now. All right, starting with the latest developments, Target in the most recent quarter generated a 5.2% operating profit margin compared to 3.9% in the third quarter last year. Their team made progress improving profits through disciplined expense and inventory management and efficiency efforts. Now, remember, Target was one of the beneficiaries of the coronavirus pandemic. Competitors were forced to shut their doors, restaurants were closed, people had more money in their pockets, and Target remained open. In that time, Target's business absolutely thrived. So when economies reopened, there was a bit of a readjustment, and that's what Target had gone through in 2022 and early 2023, and it's now rebounding off of those lows from that time, rebounding in the sense of the business is rebounding. So early results of their initiative to add efficiency are already saving hundreds of millions of dollars in costs this year and uncovering significant long-term opportunities. The company increased its GAAP and adjusted EPS by over 50% since the third quarter of 2019. So one of the problems Target had coming out of the lockdowns is an inventory problem. Not only did it have too much inventory, but it had the wrong kind of inventory. It had the kind of inventory people wanted when they were spending more time at home. Things like pajamas and board games and TVs and gaming consoles, things that were popular when we were staying at home. But now that economies are reopened, those aren't the kind of things that are popular. There's different things that people want now, things like makeup and travel equipment, luggage, etc., things like that. So Target has been rebalancing its inventory and shrinking its inventory, and it's done a good job of that. It now has 14% leaner inventory position at the end of Q3 compared to 2022. And while planning cautiously, they're well stocked for the holiday season, including in growth categories and flexibility to meet guests' needs. So not only did they shrink inventory, but they also changed the inventory structure, changed the type of inventory they had to meet what customers are looking for right now. And the one of the most popular things Target has done over the last several years are its same day services. In this segment here, Target is highlighting that they experienced a 12% growth in drive up in the most recent quarter, with nearly 100,000 Starbucks orders weekly since scaling that service nationwide. If you don't already know, you can order Starbucks online and go pick it up in the Target parking lot. They'll bring it to you, so you don't have to get out of your car. That service has been extremely popular with consumers, especially during the pandemic when people did not want to go inside stores. And so the fact that it's growing on top of the explosive growth it already had during the pandemic is truly showing how popular this service is. Notably, the reason this is great news for investors is not just that consumers find it incredibly convenient, it's also that it saves Target on a lot of costs on shipping and fulfillment. if Target gets you to go to pick it up at their store, Target doesn't have to pay for shipping and handling and sending that item to your doorstep. You're going to pick it up, and it's an online order, so that removes the need for a cashier. So it's an incredibly more profitable transaction compared to when you buy online and have it shipped to your house. And so this is great news, not just for the near term, but longer term as well for target investors. So Target offers investors a 3.1% dividend yield. Of course, there are stocks that offer a better dividend yield and there are stocks with lower dividend yields. But for passive income investors, remember you're exposed to not just the dividend yield return, but the total stock return, which includes the change in the stock price. So that's why we need to look at more than just the dividend yield when we're looking at a dividend stock to buy. And Target gives you that holistic, well-rounded business that could deliver growth in profitability, which can then fuel growth in dividends, which could also fuel growth in the stock price. And look at the excellent growth Target has demonstrated in the last decade, growing revenue from less than $75 billion all the way up to $106.89 billion in the most recent 12 months. Remember around 2015, 2016, the whole story around Target was it's over, the business is done, Amazon is going to kill every brick and mortar business. It's a disadvantage to have these brick and mortar locations, and Target has 2,000 of them. There's too many, it's going to take too long, it's done for. Well, Target has turned things around. It turned those stores, which people thought might be a disadvantage, into an advantage with the drive-up service. You can buy online and go pick up your item at a Target parking lot, and it only takes a couple of hours to get your online order. That's faster than Amazon, and that will remain faster than Amazon for a long time. As fast as Amazon is in getting your items to your doorstep, it's going to be hard for Amazon to be faster than Target in this category. So this turned what was a disadvantage for Target now into a competitive advantage against Amazon, and it could hold off Amazon for some time because of this. The operating profit margin was heading in the right direction during the aftermath of the pandemic. It was rising steadily, and then you had the reopening, which hurt Target in the profitability segment because it had too much and customers were switching their spending patterns. Target had to, remember, they did their massive promotional campaign offering discounts and incentives to get rid of that inventory, and that hurt profitability somewhat. But it was still positive, right? They went from a record high operating profit margin of around 8% during the lockdown phases down to about 3.5% at the worst. And now it's bouncing back to 4.6%. Management said it should get back to its long run average of 6% in the next year or so. Analysts tend to agree with that profit margin expansion story, although they think 2024 is going to be another year of falling sales for Target. Analysts expect Target sales to fall by 0.4%, but earnings per share to rise by 9.2%. And in 2025, they expect revenue to grow by 3.1% and earnings per share to grow by 11.7%. So solid earnings growth expected for Target over the next couple of years. And then I mentioned they've mostly fixed their inventory problem. You can see inventory reaching this high of nearly 16 billion in late 2022, and that decreased nicely closer to 12 billion. This latest buildup was getting ready for the holiday season. I wouldn't be surprised if it drops further when Target reports its next quarterly results, which will include the holiday shopping season. Also, this inventory is better balanced now. It's inventory that customers prefer versus the kind of inventory that was popular during the pandemic. So that's why this was such a problem, not just because how high inventory was, but because of the mix of inventory. It was not good inventory. And so you could see on the bottom metric here, this is the days inventory outstanding. This is how many days it would take for Target to sell its inventory. It's a measure of the balance of inventory comparatively. So if you look back the last 10 years, this inventory level is about where Target has been over the last decade, right? It's not a troublesome inventory level here. And so you can see in its metrics that the inventory problem has mostly been resolved for Target. And finally, Target stock is not expensive, trading at a forward price to earnings of 15.52, meaning you have potential for increasing stock price because you're getting this stock at a reasonable or closer to cheaper valuation. So for all of those reasons, I think Target is an excellent dividend stock to buy, and why I've placed Target as one of my top 24 stocks to buy in 2024. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.